The pathway to success for anything in life is simple. Step 1. Define your purpose. Step 2. Determine the risk and reward associated with fulfilling that purpose. Step 3. Establish the rate of success and failure. Step 4. Refine your skill set, and for that skill, create the most conducive environment for increasing the rate of success. Step 5. Execute. Step 1 can only be answered by you. What is your purpose of entering the stock market, and when is that purpose to be fulfilled? You cannot just enter this market with the mindset of, I want to make as much money as possible. If that's how you feel, go to a casino. You must establish some sort of expectations. If not, greed will defeat you. When the NBA season starts, do the best teams come out and say they just want to win as many games as possible? Of course not. Their purpose is to win the NBA Finals in June. The formula for success is the same no matter what you do. How you do anything is how you do everything. So again, before we move on to step 2, define your current purpose of entering the stock market. This Excel sheet here represents a pretty basic trading formula, but it's quite effective in determining how your process should look for whatever goal you currently have. The green tab represents winning trades. The red tab represents losing trades, while the blue represents the cumulative amount. This is the formula I am currently using. It is shaped by my personality, but my formula does change based on my goals at the time. I am currently looking to make 20% on my successful trades and allow myself to only lose 10% whenever I am wrong. Say I want to triple my money in 6 months. With this formula, total profit amount needs to be double my position size per trade. If I am able to trade 25 opportunities in 6 months that meet my 2010 risk to reward ratio, I can triple my money if I am accurate just 60% of the time. It is important to also be aware of how much of your total portfolio is utilized per trade. Position size is a form of risk management. This next tab here is the Don't Blow Up Your Account tab. With the same stop loss of 10%, you'll be able to see the grand difference that using less of your portfolio per trade can really make. If you'd like to use this Excel template, just leave your email and I'll be happy to send you this Excel, along with the invite to a live Zoom webinar where I will fully go over how to utilize this template and how to effectively translate it over to step 4, the skill of reading charts. In the meantime, here is a basic example of what that process looks like. Dating back to June, here we have the price chart of the stock SIG. In order to find trends in a stock, you need to use a website like the one I always use, TradingView. If you do not already have an account, use my link attached below to sign up, and you'll get $30 off if you ever want to upgrade from the free version. Now back to SIG. There's no need for in-depth technical analysis. This chart is as simple as it gets. When I include this indicator, the 200-day exponential moving average, you can see that since July, whenever it crosses below this indicator, the price increases significantly. Now let's highlight some price levels of support and resistance. As you can see with each line, before the price of the stock continues to increase, multiple times, it either finds support or gets rejected at each line. That is significant. So before I trade SIG, the next thing I want to know is how much does the price increase whenever it does cross the moving average? How quickly does it happen? And is there any congruency between these separate instances? This is where you incorporate your simple trading formula inputs. In this scenario, we are working backwards. We know your stop loss is indicative of your risk tolerance, but it should not just be at a random price on the chart. In order to move the probability of success in your favor, your stop loss should be set at or within a significant point. A line of resistance or a line of support is considered a significant point. Whenever it touches the indicator, the more consistent the percentage that the price increases by, the more the odds are in your favor. The more consistent the amount of time it takes to get to that price, again, the more the odds are in your favor. The trend started in June, but let's look at the last 3 times the price has crossed our indicator, the 200-day moving average. On the last day of July, the price crosses the indicator. the price immediately goes further down. However, we established this white line of support as significant. So before you even enter the trade, that is the level where you should have already drawn your stop loss. 12% below the price we entered at. It falls considerably, but never reaches that 12% stop loss. Then 20 days after crossing the indicator, it is up 29%, and then shortly after, the price momentarily dips. On September 18th, it crosses the indicator again. This is where the fun begins. The previous stop loss was set at 12%, correct? It was set at that 12% because of the significant line of support. Now look at this line of previous resistance. It is also 12% below the price we entered at. And then, just like clockwork, on October 9th, 20 days after crossing the indicator, it is again up 29%. And shortly after, the price momentarily dips. Want to take a guess what happened the last time it crossed the indicator? Yeah, up 29%, but in this time, it actually only takes 18 days. The 12% stop loss is again the same as the significant line of resistance. And after those 18 days, it momentarily dips. So it's December 11th, and as you can see, the price has crossed the indicator again. If this stock trend is still intact, you can anticipate it to rise 30% by January. So remember the trading formula Excel template. My personal risk to reward ratio is 2-to-1. Specifically, 20% profit for successful trades and 10% loss for unsuccessful trades. This stock is actually trading at 30-10. And imagine if I wanted to trade once or twice a month. This stock has been doing just that since July. What does that tell you? For however long a trend in a stock lasts, that stock typically has an inherent risk to reward ratio, just like you do. It's essentially called its risk premium. That premium changes based on whatever trend that stock is in. If you can accurately identify the stock's current premium, and if that premium aligns with your own risk to reward ratio, and you're comfortable with the time frame it takes for the trade to come into fruition, it means you have found a stock that is currently moving with the exact way you like to trade. This simple alignment moves the probability of success in your favor. If you are not a trader but a long-term investor, with this technical analysis, you are able to identify the best opportunity to buy more of the stock and not just buying the dip blindly. I do want to reiterate, identifying a trend with technical analysis is not always this simple. This is just one example, and it's always only a piece of the puzzle to maximizing your probability of success. Coupled with analyzing the industry sentiment, a complete Goodtrader analysis allows you to maximize your probability of success. Today, we just took one step closer to becoming a good trader. Thank you for watching.